China about to kick on again? My next guest thinks so. It may have officially become the world's second biggest economy, but Kelvin Tay says it's been asleep for the last 2 years. He's chief investment strategist at UBS Wealth Management in Singapore, and he joins us now. Kelvin, it's awaking from a 2-year slumber. Explain that statement of yours.
We believe that the Chinese market is finally starting to perform, and the reason for that is because in the last 2 years, the liquidity constraints have actually prevented the market from actually outperforming the rest of Asia ex-Japan. But we believe that with the slowdown in the economy next year, and we're projecting GDP growth at 8%, that the Chinese authorities are likely to reduce the reserve requirement ratio, and also if the Chinese economy falters more than expected, they are perhaps likely to actually spend close to 2 to 3% of their GDP in stimulus measures. And therefore, for that, we believe that with improving liquidity outlook, the Chinese stock market should also gradually improve.
So if the Chinese economy slows more than expected, that's a good thing for stocks, you're saying. Specifically, which stocks?
We believe that the domestic consumption stocks are likely to be the main beneficiaries here, and likewise some of the banking stocks as well, because the banking stocks have actually come up a lot, and where valuations are concerned, they are actually very, very attractive.
Now, you told us earlier, in early December, that the European crisis wasn't going to derail the Chinese economy in 2012. But things have changed even since the beginning of December with regards to the outlook here in Europe. Do you want to change that statement?
No, not at all. If you look at the percentage of exports if you look at the Eurozone exports as a percentage of China's GDP, it amounts to only about 4% of its total GDP. Yes, there is an impact on the exports, but in total, if you look at it on a holistic basis with regards to the rest of the economy put together, the impact is actually not that great. Because of the deterioration in the Eurozone situation, we've actually brought down our GDP growth numbers for China from about 8.3% to 8% for next year. So the impact, if you ask me, where the Eurozone crisis is concerned, is going to amount to about 0.3% on the total GDP.
How about the impact of these cheap ECB loans to European banks? What's the impact on your region?
We believe that should be a net impact, because even though these banks have access to cheap funding right now, they're not going to be expanding their balance sheets actively globally anywhere soon. And I think what they are likely to use is basically they're likely to use that facility to actually refinance a lot of the bank bonds that are likely to be due in the first quarter of next year. And therefore, if you're looking for an expansion of balance sheets where the European banks are concerned, I'm afraid that we are probably in for some disappointment there. You can see from the way the euro has actually reacted yesterday as well. Initially, it actually strengthened, but then after that, it lost most of its gains back down to about 130.
Now, you often tell us that markets just become ripe for a rally. Is that the situation that we've been seeing in the last few days with this Christmas rally?
Yeah, I think there's some semblance of that with the traditional year-end rally, window dressing by fund managers going on. But I think one key reason for that is because of the positive data that actually came out from the US economy in the last couple of days. If you recall, the GDP growth numbers actually came in at about 1.8%, and that's actually higher than our own estimates of about 1.6%. But more importantly, the weekly jobless claims numbers have actually continued to actually drop, and now we're basically at a 3.5-year low where that is concerned. And it shows that some of the measures that the US government is taking is starting to have an impact. The excess reserves that the banks have is starting to actually translate into lending, and with easier credit conditions, the small enterprises are now starting to actually hire. And that's actually translating to better employment numbers as well as lower weekly jobless claims numbers.
Let's come back to equities. You are not only bullish on China, you're bullish on India as well. Explain why, because inflation is still a huge concern there.
Yeah, we believe that inflation has more or less peaked out, and we should actually see inflation starting to actually gradually slow down. And that's largely because of the impact of lower commodity prices in the last 6 months as well. The Indian stock market, the Sensex, has not actually performed up to expectations. On a relative basis, if you look at it on local currency terms, they've actually outperformed the rest of Asia. But if you translate it into US dollar terms, Sensex has clearly underperformed in the last 3 months. And the main reason for that is because of the underperformance of the rupee. The rupee has actually come under selling pressure in the last 2 months as investors bail out of the currency in fears that the Indian government, with a huge deficit problem, may not be able to stimulate the economy as much as the other Asian economies. But we believe that the Indian rupee has been oversold and therefore should see some stabilization going forward. That's one of the reasons why we think that the Sensex should actually perform better in the next couple of months.
Kelvin, finally, you have the MSCI Emerging Market Index down 20% this year. underperforming the markets in the developed world where the problems are stemming from. To be fair, the problems mainly in Europe. Is 2012 going to be the year that emerging markets outperform their developed counterparts?
We certainly think so. The fundamentals where the emerging markets are concerned are certainly a lot healthier and better than the developed markets. The only concession that I would make is that about 20% of the MSCI Emerging Markets Index is actually Eastern Europe. And Eastern Europe could actually suffer from some of the liquidity drying up in Europe, could suffer from some of the bank recapitalization, the shrinking of balance sheets that's going on with the European banking system right now. So that is the only part that I think is likely to actually underperform. But Latin America, and in particular, and as well as Asia ex-Japan, are likely to perform much better than the developed markets next year.
Kelvin Tay, Chief Investment Strategist at UBS Wealth Management, thanks very much for sharing your thoughts on 2012 with us.